All right, welcome to the Explainer. We're looking at the market today and something feels off. There's this really strange tension, right? On the surface, everything looks great, maybe even a little too perfect. But dig just a little deeper and you can feel it, that sense that the ground is about to shift. So let's figure out what's going on.
So let's just start with the obvious, right? The S&P 500. I mean, it's hitting a new all-time high pretty much every single day. Now, a chart like this, it usually screams confidence. You see this and you think, hey, everything's going up. What could possibly be wrong? And yet, that's the big contradiction we're tackling today. Even with all these record highs, there's this feeling, this palpable sense of unease. It really feels like the entire market is just holding its breath, just waiting for that other shoe to drop. So what is really going on here? Okay, so to get why everyone's so tense, you have to look at what's coming up. This isn't just a calm market. It's more like that eerie quiet right before a massive storm. A storm of economic data. I mean, look at this. It's because everything is happening all at once. We're talking about 1 week. In that single week, you've got the Fed's interest rate decision, you've got GDP reports from the US and globally, the jobs report, that super important PCE inflation data, a big Treasury announcement. Oh, and on top of all that, earnings reports from over 160 companies. Seriously, any one of these things could rock the market. But all of them together? Yeah, that's why everyone's on edge. And this all leads to a really fascinating disconnect. You turn on the financial news and all you hear are pundits saying, oh, we're nervous, valuations are totally stretched, this has got to be a bubble. But then you look at what the market is actually doing, and guess what? It's showing zero fear. Implied volatility is way down at a 13-week low. It really proves that old saying, right? Don't listen to what people say, watch what they do with their money. And right now, investors are just holding on tight. Okay, so out of all those data points we just ran through, there's one that really towers above everything else, and that's the Federal Reserve's decision. Right now, you could say the Fed is walking a very thin tightrope. You see, they're caught between a rock and a hard place. They've got these two powerful, opposing forces pushing on them. On the one hand, if they cut rates, that would really help ease the government's massive interest payments on its debt. It's a huge, growing cash flow problem. But on the other hand, if they cut rates right before an election, well, that could make them look political. And that damages the one thing they can't afford to lose, their credibility. One analyst had a great way of putting it. They said the Fed is playing checkers right now when they really should be playing chess. See, by focusing only on today's inflation and jobs data, they're just reacting to the last move. That's checkers. Playing chess means thinking 3, 4, 5 moves ahead and looking at the really big strategic threat, the absolutely unsustainable cost of U.S. debt. That's the problem that really threatens long-term growth. So, okay, this all sounds pretty high level, right? Fed policy, debt. How does this uncertainty actually affect the real world? Well, let's zoom in and look at a perfect example. We're going to use one key commodity here, copper. Just look at this price difference. It's wild. Globally, on the London Metal Exchange, copper is trading for about $4.40 a pound. But in the US, it's shot all the way up to almost $5.85. Why? That massive premium is a direct result of just the threat of a 50% tariff on copper imports. So as you can imagine, this huge price gap created a massive arbitrage opportunity. It's just simple math. So traders started rushing to get copper into the US to lock in that higher price. And the result is pretty incredible. A staggering 55%, that's more than half of all the copper held on global exchanges, is now sitting in New York warehouses. And to put that into perspective, this flood of metal has pushed US copper inventories to their highest level in 7 years. So this isn't some small market shift we're talking about. No way. It's a massive, you could even say historic, market dislocation. And it's driven entirely by policy risk. And you can see how this sets up a really dangerous situation. What if those tariffs don't happen? Or what if they just get delayed? Well, that huge price premium could literally disappear overnight. And then what? The US is left holding the bag, a massive inventory glut, which could cause prices to just crash. It's a perfect real-world example of how abstract policy uncertainty creates very real financial risk.
Okay, for our final stop, let's bring it all home. Let's see how this exact same theme, that calm surface hiding some really deep uncertainty, plays out not across a whole market, but inside a single company that's right at the center of everything: Google. So on the surface, just like the broader stock market, Google looks like it's absolutely firing on all cylinders. I mean, look at these numbers. They brought in $96 billion in revenue in 1 quarter. That's a 14% jump from last year. And here's the really impressive part. Check out the operating leverage. A 14% revenue increase led to a 19% jump in net income. That tells you the business is just incredibly efficient and profitable. But here's their ultimate weapon, their secret sauce. Over the past year, Google has generated almost 67 times billion dollars in free cash flow, just cash. And in this super capital-intensive AI arms race that we're in, cash is absolutely king. And Google has more of it than pretty much anyone else. This is the war chest that lets them outspend and outinvest all their rivals. So the big question is, where does all that cash come from? Well, the answer is actually pretty simple. Search. A massive 56% of Google's revenue still comes from its good old-fashioned advertising business. So even with all the amazing growth in their cloud and YouTube divisions, at the end of the day, the company's financial health is still fundamentally tied to you and me searching the web and clicking on ad links.
And that brings us to the existential threat. The paradox, really. The very AI technology that Google itself is pioneering is designed to do what? To give us direct answers, not a list of blue links to click on. And this changes everything. It completely disrupts the core advertising model that has powered not just Google, but basically the entire internet economy for the last 20 years. Which leaves us with this one single huge question. And it's not just a question for Google, it's for the entire internet. In a world where we all get our answers directly from an AI, who is going to pay for the clicks? It's a question that could fundamentally reshape our entire digital world.